Velocity banking. Can anybody tell me what the word velocity means? Yeah, speed, force, right? So to speed something up, to like increase the momentum of a thing is the velocity, right? And then banking. Write this down. I would say this is one of the main principles that you want to kind of have in your mind, in your heart, and your soul. How can I give every dollar that comes into my personal economy, my income, at least 2 to 3 jobs before I spend it, before it leaves the economy of Sebastien Boyer or of your economy? How can I do that? Take that and run with it. How can you do that? Figure that out. Of course, I'm going to show you some ways, but always be thinking that. Always be thinking, how can I multiply that dollar before it goes out? Because what do most of us do? We get income, it goes into the checking account, and we pay the bills. We get income, it goes in the checking account, we spend it. So that is, it's not growing, right? Money sitting in your checking or savings account, how much interest are you getting in a checking and saving account? Yeah, and there's something called inflation, right? So guess what? Is your money growing value? Is it maintaining the same value? No, it's not, right? So how can we velocitize that money? How can we get compound interest coming back, right? That's another question. How can we practice the strategy of building credit and having that compound credit effect happen that we talked about earlier? Okay, all of that is velocity banking. Okay, now the number one thing, well, there's 2 things that you need to know if you're going to start practicing velocity banking. Number one, you need to know yourself, right? Because not everybody should be dealing with credit. Just like not everybody should have a drink, right? I can have a beer or 2, but I have friends who shouldn't have a beer or 2 because there's a problem there, right? So it's not a judgment, it's just know yourself. If you can't handle credit, if you have experience of getting credit and you can't help yourself, you're gonna go shopping or you're gonna go to Vegas, velocity banking may not be the right thing for you. It's not for everybody. So this is a disclaimer. Velocity banking is not for everybody. It's for those of you who are prepared to be disciplined, number one, with your money, with your finances, and you're prepared to put something into practice that is not going to show you results tomorrow, but it's going to show you results over time, and it's something you're going to practice for the rest of your life, okay? So know yourself, number one. Number 2, you need to know your 4 numbers. Anybody know what your 4 numbers are? Huh?
Your credit score?
No. No. Huh? No, it's okay. So your 4 numbers are, number 1, income. And now you can practice this personally or in your business, okay? Number 2, debt. Number 3, expenses. And this is where most of us make a mistake. We put that together. They're different, okay? And then number 4, cash flow or discretionary income. I've had business owners apply for loans, they're making $100,000 a month, but when we look at the bank statements, they're cash flowing $150, $200. Because why? They're paying themselves, extremely large salaries. They're overspending where they don't need to spend, so the business is not showing cash flow. They're writing off all the taxes they can. We all want to save money on taxes, right? Yes. Your CPA, most CPAs are going to just advise you, every way you can to save money on taxes. And that's good. I'm not saying don't do that. But if your goal is to grow your business and you're looking to expand and grow, and you're going to need to show a bank tax returns and bank statements, what they're going to be looking for, remember that term, debt service coverage ratio? They're going to be looking at that. They're going to be looking at your cash flow. So if you're not cash flowing, you're not going to be able to qualify for that loan, or maybe you do, but you're not going to get what you're wanting. If you're looking for a larger loan, you might get something, small to start with, right? So yes, you want to save money, but you also have to be strategic and planning in terms of what are your goals, right? What are your goals? Are you planning to expand and grow? Do you want to get a loan? If so, focus on showing on your ledger. His name is Ledger, guys. Cash flow. You got to show the cash flow, okay? So cash flow is king, okay? So your income is what comes in. Your debt is loans, credit cards, anything that eventually you can pay off, mortgages, etc., right? And your expenses are never going to go away. Gas, food, electric, utilities, these are things that are always going to be there, right? So before you can do anything, you have to know these 4 numbers. Okay? Now, once you know those 4 numbers, what's going to happen is you're going to be able to start seeing where your money is going. You're going to be able to see where this is going. Yeah, you're paying that, but how much of this is going to Netflix, food, entertainment, drinks, vacation, well, gas you gotta pay, right? But how much are we eating out, right? How much, if your money's going here, you might have a problem. Bottom line is, where are you bleeding, right? Where are we bleeding, right? Because the goal is to create more cash flow, right? So there's 2 ways to do that. One way is to decrease expenses. And then the other way is to do what everyone here in this room has already done, is to become an entrepreneur, is to create revenue, create income coming back. More money in, less money out, okay? So that's how you increase cash flow, right? So we should all be seeking for multiple streams of income, at least what? How many? 7 streams of income is what we should be looking at, right? Because you never know what's going to happen. And if you have 1 stream of income and something shifts in the economy, that income is locked, and then guess what? You're in trouble. You have 7 streams of income, when one is a little slow, another one might pick up, right? It doesn't mean you have to have 7 different businesses, but even within your own business, how can you create 7 streams within your existing business, okay? Because that's going to create more cash flow so that you can pay off your debts. Now, the traditional way of eliminating debt, right, that everybody's probably very familiar with, is called debt snowball. Who's heard of debt snowball? Everybody heard about debt snowball? Right, so debt snowball is popularized by Dave Ramsey, Rich. It's very, it works, okay? It works for everybody. Everyone can eliminate debt by practicing debt snowball. It's very simple. You take your extra cash flow and you throw it at your lowest balance debt, right? Because what's going to happen is you're going to pay that debt off probably faster than you would your other debts. You get a sense of accomplishment, gives you some motivation, and now you move that cash flow and that previous debt that you paid off, you move that money, that income, to your next debt, right? So eventually you snowball and you will pay off your debts, which is a very safe, conservative way of eliminating debt. It will work if you do debt snowball, okay? There's debt avalanche, which is also another form of debt snowball, basically focusing, instead of just the lowest balance, focusing on the highest interest rate and the highest limit, or the highest balance and interest rate combination, basically. Okay, that is not basically that's not going to get you that immediate sense of gratification. So most people practice debt snowball. Again, know yourself. If you know that you can't handle credit and you can't leverage debt, you're not good with it, yeah, you want to practice it, but if you know that you have a problem with it, debt snowball might be the thing. Also, if you don't have good credit, you might have to start off with debt snowball. Why? Because see, what velocity banking, what the strategy is using a line of credit, and that could be a personal line of credit, it could be a business line of credit, it could be a HELOC, which is a home equity line of credit, right? And it can also be credit cards. Why? Because all of these have one thing in common. They're revolving. Again, the objective or the goal here is not to take credit cards, put debt on the credit cards, sit on high balances, making minimum monthly payments. That's not velocity banking. That's the opposite of velocity banking, okay? But by getting your hands on a line of credit, what you're gonna be able to do, if the line of credit exceeds your annual cash flow, there are parameters that you have to work in as far as the size of the line of credit and how you're going to use that line of credit, okay? And what you're basically going to be doing is you're going to be identifying all of the debts that you have, and you're going to identify which debt is going to, when you get rid of that debt, is going to release the most cash flow, right? And you're going to use that line of credit to, in one time, in one large sum, make a payment to that debt, whatever it is. Now, most of the time, this is going to be effective when you have larger debts, like a mortgage, right? Or multiple mortgages, right? Otherwise, if you don't have a lot of debt, that snowball is going to do the trick. Just, you know, if it's a small amount. But if you're dealing with larger debts, and it's going to take you 30 years to pay off a mortgage, you can do debt snowball. You can throw your cash flow at it. But when you run the numbers on the board, and we have someone here today that is a running numbers expert and master, and he's going to come up and I'm going to introduce him in just a sec. You're going to be able to basically use that line of credit, and you're going to make a chunk payment to the debt. You're going to take your income, put it into the line of credit, pay your expenses, and basically live through the line of credit. Okay? Now, if you combine that with credit cards, with cash back, rewards, points, and travel points, so whatever bills you can pay with the credit cards, you can create another form of currency with credit cards with these cash back and rewards points. So when you need to buy something like Christmas presents, you could just use your rewards points. Or when you need to travel, you could use your travel points, pay for your flights, hotels, with no out of pocket. The points are going to do it for you, right? So where can you spend credit cards? When you buy groceries, gas, right? So you're going to have to separate what can you do with what you have, right? Same thing with the line of credit as well. You need to know what are the features of that line of credit. What does it allow me to do, right? Because some lines of credit come with checkbooks. You can really write a check. Some don't, where you have to balance transfer to another account, and then from that account, transfer the money to the accounts that you're looking to pay. Okay, so you need to know what you're working with. You need to know for these debts and expenses, which ones are going to allow you to use a credit card, which ones are going to allow you to use a line of credit. Do you need to write a check? Can you do a transfer? So preparation is the most important thing here. This is not something you do, I'm sorry about my stomach. This is not something you do haphazardly and you just say, hey, I'm gonna start doing this tomorrow. You can't. You need to take the time, and it might take you a couple months to prepare, because you need to know, you need to plan the day that you have your most income, right? And having already mapped out what you can spend from these different accounts and how you can spend them, right? So that the day that you put this into effect, you're not going to start tripping up in terms of what you can or cannot do. Because if you just kind of go at it and you don't plan ahead and you don't prepare and you don't know what you can do, then on that day, you're going to hit walls, right? And then you're going to get frustrated and chances are you're going to give up. But if you plan ahead, you know what accounts you can use to pay different expenses and bills, you're going to be able to use the line of credit. Now, if you don't have good credit, you're not going to be able to get this, right? So if you're in the room and you don't have good credit, you're going to have to start eliminating debt using debt snowball, and then build and fix and repair and get your personal credit where you can qualify for that line of credit. So that should be your goal, is to get your credit so you can qualify, so that you get your debt tool that you're going to use to practice this strategy of velocity banking. Okay, so let me map it out a little bit for you guys. And again, when you see the numbers on the board, that's when it makes sense. And sometimes it takes people, looking at 100 scenarios before it clicks and you get it. But basically, if I have a line of credit and that line of credit is going to be 3 times the size of my annual cash flow, okay, then that means I can take maybe no more than 80% maximum, 60% is ideal of that line of credit, and in one payment, pay that debt, okay? One payment. Now, on the same day, I'm also going to pay my expenses from that line of credit, and on the same day, I'm going to transfer my income into that line of credit. Moving forward, I'm going to use that line of credit every single month to pay my bills, my expenses, and all of my income is going to go back into the line of credit, okay? Now, what's going to happen is the average daily balance of the line of credit is going to stay low because you're not sitting on that high balance, you're putting your income in every time you get it on the same day, okay? So when you run these numbers, you're going to see that that debt is going to be reduced a lot faster if you were just using your cash flow. Now, it's going to take you 8 to 12 months to get the line of credit balance back down. And then you're going to do it again. You're going to chunk it again. Okay? And then you continue to just practice this strategy along with the credit cards, rewards points. Okay? Along with that. And when you do that, there are cases where people have been able to eliminate debt that would normally have taken them 30 years, paying it off in 5 to 7 years, right? Avoiding interest in the hundreds of thousands of dollars, right? Now, once you eliminate debt, then you're going to use the same strategy, the same principle, because this is all about leverage, right? And you're going to apply it towards how can I grow? How can I use that debt to invest and grow, right? So that, in a nutshell, is velocity banking, in a nutshell.